Bismillahirrahmanirrahim. This is the second video on income flows versus cash flows, and in this video we will solve exercises on cash flow categorization and interconnections of financial statements. Please like, subscribe and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. So let us start with the first exercise or the case. We have the combined data for 3 years for two firms, and these amounts are in millions. One of them is Amazon.com, a rapidly growing internet retailer, and the other is Kroger, a retail grocery store chain growing at approximately the same rate as the population. So we have to identify each firm and explain our reasons. So if you look into the figures, uh, we will see that firm A is Amazon.com while firm B is Kroger. And the reason why I am saying that is going to be explained in few minutes now. Now, Amazon is a rapid growth is currently in a rapid growth phase with significant expansions in operational scale and infrastructure. Now, the growth requires substantial investment in working capital to support increased sales and operational demands. Unlike firms heavily reliant on fixed assets, Amazon.com's business model will not be heavily fixed asset intensive. As a result, there will be no significant add back required for depreciation in Amazon.com's financial considerations. The company's growth primarily demands investment in inventory, fulfillment centers, and technology infrastructure. So, this strategic emphasis on working capital and technology highlights Amazon's agile and scalable approach in the competitive e commerce sector. Kroger is currently in a phase of moderate growth, distinct from Amazon.com rapid expansion phase. So obviously Amazon is in a rapid expansion phase while Kroger is in a moderate growth phase. Now depreciation of buildings and equipments at Kroger will result in an add back when calculating financial metrics. The combination of depreciation, add back, and conservative growth in operating working capital will lead to Kroger's cash flow from operations exceeding its net income. This financial scenario underscores Kroger's stable operational strategy, where the utilization of depreciated assets enhances cash flow performance. This contrasts with Amazon.com's strategic emphasis on investment in working capital and technology to fuel rapid growth in the competitive e commerce sector. So, what we can see is that firm A is Amazon.com while firm B is Kroger. Let us look into another exercise. Again, we have 3 years of combined data for two firms. The two firms experience similar growth rates in revenues during the 3 year period. One of these firms is Accenture Limited, a management consulting firm, and the other is Southwest Airlines, a provider of airline transportation services. So we have to identify each firm and explain our reasons. Now, Southwest West Airlines, as a transportation service provider, maintains a high fixed assets intensity due to substantial investments in aircraft, airport facilities, and related infrastructure crucial for its operational needs. So this results in Southwest Airlines having a larger add back for depreciation expenses in its financial reporting process. Accenture, in contrast, operates as a service oriented firm with a business model centered around human capital, technology, and intellectual property rather than tangible fixed assets. Consequently, Accenture requires a smaller add back for depreciation in its financial calculations as compared to Southwest Airlines. Now, the difference in fixed assets intensity between Southwest Airlines and Accenture underscores their distinct operational strategies and financial reporting dynamics. Given that both firms are growing at an equivalent rate, their investments in working capital should exhibit minimal variance. Additionally, neither firm maintains significant levels of inventory. This operational similarity suggests that both companies manage their working capital efficiently in alignment with their growth trajectories, focusing more on deploying resources effectively rather than stockpiling inventory. This strategic approach helps optimize their capital utilization and supports their respective growth strategies despite operating in different sectors with varying asset intensive profiles. Due to the nature of their business operations, Accenture is anticipated to have larger receivables uh, as compared to Southwest Airlines. Now, this expectation arises from Accenture's service oriented business model, which typically involves billing clients for services rendered over extended periods, resulting in a higher volume of accounts receivable. In contrast, Southwest Airlines, as a transportation service provider, predominantly generates revenue from ticket sales, which are often settled at the time of purchase or shortly thereafter. Therefore, the relative size of receivables reflects the differing dynamics of revenue recognition and billing cycles between Accenture and Southwest Airlines. Southwest Airlines operates on a business model where it typically receives cash from customers prior to providing airline services. This prepayment practice contributes to Southwest Airlines experiencing a cash flow from operations that significantly exceeds its net income. In contrast, Accenture's revenue model involves billing clients after services are delivered, leading to a different cash flow and net income relationship. Southwest Airlines upfront cash collection from ticket sales underscores the efficiency of its cash conversion cycle within the airline industry. This financial strategy enhances Southwest Airlines' liquidity and operational flexibility compared to Accenture, which operates under a service based billing cycle. So, to conclude, Firm A is, is Southwest Airlines and Firm B is Accenture. Let us look into one more exercise. Three company years of combined data for two firms is given below. One of these firms is FedEx, a relatively high growth firm that provides courier services, and the other is Kellogg Company, a more mature consumer foods processor. So we have to identify each firm and explain the reasons for that. Now, firm A and firm B report, what you can see is that they have similar levels of net income. However, firm A exhibits notably higher cash flows from operations than firm B. This discrepancy suggests that firm A experiences larger add-backs or smaller subtractions related to additional investments in operating working capital. Now, firm A's ability to generate higher cash flow from operations indicate efficient management of operational cash flows. This efficiency could stem from effective working capital management practices or reduced need for additional working capital investments compared to firm B. FedEx strategically invests in processing centers, aeroplanes, and trucks to optimize the movement and delivery of customer packages. These investments play a crucial role in enhancing FedEx logistics and transportation capabilities. Processing centers, aircraft, and ground transportation assets are key components of FedEx infrastructure aimed at ensuring efficient package handling and timely deliveries. The acquisition and ongoing maintenance of these assets are integral to FedEx operational strategy, supporting its extensive network and high service standards. FedEx investments in infrastructure are geared towards meeting and exceeding customer expectations within the competitive logistics industry landscape. Now, as already stated, FedEx operates in a capital intensive industry with significant investment in processing centers, aeroplanes, and trucks to optimize logistically efficiency and accelerate package delivery across its extensive network. So, these investments contribute to FedEx incurring a larger depreciation expense add back compared to Kellogg's, which operates less capital intensive processing plants for food products. Despite being in a high growth phase relative to Kellogg's, FedEx maintains minimal levels of receivables and inventories, resulting in relatively minor operating working capital investments. Now, FedEx prioritizes substantial resources towards acquiring additional fixed assets, exemplifying its robust capital expenditure strategy. This strategy focus is underscored by FedEx significant larger cash outflows for investing activities compared to Kellogg, highlighting its commitment to infrastructure development within the competitive logistics sector. FedEx employs external financing to bolster its growth strategy and secure additional funds for expanding its operations. This approach allows FedEx to leverage capital markets effectively in support of its expansion initiatives and logistical infrastructure investments. In contrast, Kellogg reports a net cash outflow from financing activities, reflecting actions such as debt repayment, dividend distribution to shareholders, and the repurchase of its common stock. Kellogg's financial strategy emphasizes managing existing financial obligations and returning value to shareholders through prudent financial management practices. The contrasting approaches highlight FedEx's proactive stance in utilizing external financing to sustain and accelerate its growth trajectory, while Kellogg focuses on maintaining financial stability and enhancing shareholder value through strategic financial actions. So, if you look into the numbers, firm A is FedEx and firm B is Kellogg's. Let us look into another exercise. Uh, 3 years of combined data for two firms is given to us. One of these firm is eBay, an online retailer with a 3 year growth in sales of 37.3%, and the other is TJX Companies Incorporation, a specialty retail store with a 3 year growth in sales of 39%. So we have to identify each firm and explain the reasons. So obviously, if you look at the numbers, firm A is eBay and firm B is TJX, and we will try to find the reasons for that. Now, if you look at the two firms, both the firms demonstrate comparable level of cash flows from operations. Firm A maintains high investment in non-current assets as compared to firm B. This characteristic is indicative of firms A's faster pace of expansion. eBay prioritizes investment in information processing technology. The company's cash flow from operations is insufficient to cover its investing activities. As a result, eBay depends on external financing to meet its investment needs. TJX generates ample cash flow from operations, surpassing the needs for funding its investing activities. The surplus cash is directed towards reducing the debt. Additionally, TJX utilizes the excess funds for equity financing initiatives as such. Additionally, uh, so what we can conclude there is that firm A is eBay and firm B is TJX. Next, let's look into a more comprehensive problem. Now, here we have the information about the company Coca Cola manufactures and markets a variety of beverages. Exhibit on the right present statement of cash flows for Coca Cola for 3 years. So, we have to discuss the relationship between net income and cash flow from operations, and among cash flows from operating, investing, and financing activities for the firm over the 3 years period. So we have to identify the characteristics of Coca-Cola's cash flows that you would expect for a mature company. Okay, so Coca-Cola is similar to Pepsi obviously, and it operates within the mature company sector. We can see that the company saw a nearly 20% increase in the net income in year number 2, if you can see over here, net income. But it has experienced a slight decline in the year 2000, in the year 3 as such. The decline in year three's net income is mainly due to this decline may be due to losses from equity investment, uh, resulting in a 1.128 billion add back. And if we exclude this loss, the Coca-Cola's net income would have been approximately 7 billion. So because if we exclude, then our income would be added by another 1 million, 1,128 in that case. Then cash flow from operations, you can see they consistently increase. They consistently increase the You can see the cash flow from operations, they consistently exceed the net income. You can compare the two numbers. They consistently increase. Now, this discrepancy is primarily due to they are primarily due to the where is it? And they are primarily due to the they are primarily due to the depreciation and amortization and stock based compensation expenses. So these are the reasons as such. Then equity income or loss, you can see over here, and the net dividends that they are there, and the net of dividend that that fluctuates annually as such. So it notably contributes as a significant add back during the year 3. Now, the change in operating working capital is consolidated under the line item net change. You can see here net change in operating assets and liabilities. Now, this adjustment demonstrates minimal impact in year 2, uh, but indicates a negative trend in both year number 3 and year number 1. This may be because of increase in working capital characterized by increases in accounts receivable or inventory or prepaid expenses and concurrent decrease in accounts payable, reflecting a variety of combinations in the working capital dynamics. Coming to cash flow from operations, they consistently exceed the financing needs, as you can see. Uh, Cash flow, these are our financing needs. And the cash flow from operations are over here. And what we can see is that so they consistently exceed the financing needs for acquisition of they have acquired some fixed assets for acquisition of fixed assets and other expenses indicating the company's maturity. In year number 3, cash provided by operating activities was 7,571 million, which notably surpassed the 1,968 million allocated for purchases of property and plant and equipment. So that's how we try to build a relation. Then at the same time, Coca-Cola issued debt. Now these issuance were partially offset by debt repayments. You can see over here there are debt repayments during the same year. So overall, there was a slight net increase in debt across the 3-year period. Then surplus operating cash flow was allocated towards dividend payments. These are the dividend payments and the repurchase of company's common stocks. Now these actions, they reflect mature status of the company. They are buying as well as they are they are buying back their stock and they are even paying the dividends. And this is what was asked by us in this exercise. Identify the characteristics of Coca Cola cash flows that you would expect for a mature company. Let us look into one more exercise. Now, Texas Instrument primarily develops and manufactures semiconductors for use in technology based products for various industries. The manufacturing process is capital intensive and subject to cyclical swings in the economy. Now, because of overcapacity in the industry and a cutback on spending for technology products due to a recession, semiconductor prices collapsed in year 1 and commenced a steady comeback during year 2 through 4. We will be looking into this on the next slide. Let us complete the question. Exhibit on the next slide presents a statement of cash flow for Texas Instrument for years 0 to 4. Discuss the relationship between net income and cash flows from operations and among cash flows from operating, investing, and financing activities for the firm over the 5-year period. Okay. Now, the wide variation in sales indicates the cyclical nature of demand for semiconductors. Now, net income tends to follow the changes in the sales but with wider swings. They generally track changes in sales but maybe with the larger swings as such. So, semiconductor manufacturing is, as already said, it is capital intensive, and being capital intensive, it results in stable fixed cost that do not vary with changes in sales value. So fixed cost in semiconductor manufacturing remains relatively constant regardless of fluctuations in sales. Then net income typically increases at a faster pace than sales during the period of growth. Conversely, net income tends to decrease more steeply than sales during the downturns or decline in sales. So, cash flow from operations exhibits less variability compared to the net income. Texas Instrument strategically manages its operating working capital account to ensure cash from flow from operations. There was a noticeable increase in year number 4, as you can see, aligned with a substantial rise in the net income, indicating effective management of financial resources during the period. The fluctuations observed in operating working capital accounts align with anticipated variation in growth patterns. During period of sales growth, there is usually an increase in accounts receivable and inventories. Now, sales growth periods also typically see a rise in current liabilities. Conversely, during a decline in sales, accounts receivable and inventories tend to decrease. A decline in sales is often accompanied by a reduction in current liabilities as well. Excluding for year 1, when Texas Instruments expanded its capacity significantly, cash flow from operations consistently surpassed the requirements for acquiring fixed assets. Texas Instrument issued additional common stock primarily to employees' stock option plans. Concurrently, the company reduced its short term and long term borrowing over the 5-year period. So, companies facing high technology risk and short product life cycles typically avoid relying on debt financing. Texas Instrument directed surplus cash flow from operations, notably in year number 2, 3, and 4, towards dividend and stock repurchase as such. So, this allocation followed expenditures on fixed asset acquisitions and debt retirements during the specified periods. So this completes the second video on income flows versus cash flows, understanding the statement of cash flows. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe and share my channel and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah, I will reply you back. Thank you so much and happy learning.